Welcome back to the deep dive. Today we're not just talking about a company. We are talking about a gravitational force.
That's a good way to put it. A center of gravity for the entire market.
Exactly. We are talking about an entity that, if it were a country, its GDP would rival major G7 nations. We are, of course, tackling the absolute titan of the market, Apple Inc.
And not just Apple in general. We're looking at it right now. As of today, Thursday, January 29, 2026.
It is the day. The earnings have dropped. And, usually when we talk about earnings for a company this massive, it can be a lot of very large, very abstract numbers.
Numbers that can kind of put you to sleep, honestly. A billion here, a billion there.
But today feels different.
Oh, it's absolutely different.
Different is an understatement. I've been staring at these press releases for the last hour, and my jaw is, I think, still on the floor.
Okay.
We just got the fiscal Q1 2026 numbers, and we are looking at records just being shattered.
Shattered is the right word.
Revenue records, profit records, services records. It looks like the perfect quarter.
On paper, it is the perfect quarter. I mean, this is the kind of quarter that CEOs literally dream about when they go to sleep at night.
And there is a very big, very heavy but looming over this entire conversation. We have a job to do.
Right.
Our mission today isn't just to, fanboy over the iPhone sales figures. We have to decide if this financial fortress is actually a smart place to put your hard-earned money right now.
Exactly. And this is the classic conflict in investing, isn't it? It's the one that separates the casual observers from the serious allocators of capital.
What's that?
It's the conflict between a truly wonderful company and a questionable price tag.
Yeah.
Just because a business is fantastic doesn't automatically mean the stock is a buy.
That is such a hard concept to grasp. Sometimes it feels counterintuitive. So we're going to look at the AI supercycle everyone is screaming about. We're going to unpack something called the yield gap, which, frankly, I needed you to explain to me about 3 times before it really clicked. But it is absolutely critical for everyone listening.
What's the whole ballgame right now?
And we are going to try to figure out why the smartest value investor in history, the Oracle of Omaha himself, Warren Buffett, seems to be heading for the exit while everyone else is rushing in.
It's the ultimate showdown, right? It's the narrative versus the math. The story says buy, but the calculator...
Yep.
Well, the calculator might be saying something very, very different.
Before we get into the weeds of the iPhone 17 and all these massive billions, we have a little tool that might help you visualize the market temperature we're talking about, because context is everything here.
Right. If you want to see exactly how, let's say, heated the market is, you need data. You have to strip away the emotion and just look at the cold, hard ratios.
To track total market temperature, welcome to search and download iOS app Buffett Indicator from Apple App Store. It's a really great way to keep an eye on valuations in real time. It essentially measures the market cap of the stock market against the GDP of the economy.
A classic metric for a reason. And, of course, before we dissect the world's largest company, we have to handle the housekeeping. The lawyers get nervous if we don't.
Let's get the legalities out of the way. Full, deep value research reports can be found in the description links. All analysis is based on publicly available sources and may be subject to revisions or differing interpretations. The content is for educational purposes only and does not constitute investment advice.
And this is the big one.
Conduct your own due diligence before making investment decisions. If you want to listen to our full deep dive about this topic or access more advanced contents, welcome to join Deep Value Club membership or subscribe to us on deepvalues.ai.
All right. Formalities aside, let's look at this beast.
Let's do it. Let's start with the headline numbers. Apple just reported its first quarter for fiscal 2026. Now, for those who don't follow the calendar, Apple's fiscal year is a little weird, so Q1 actually covers the holiday season, October through December.
The big one, the iPhone launch window.
Exactly. So the revenue came in at $143.8 billion.
Okay, I want to pause there. Immediately, we hear billions thrown around all the time in finance. The word billion has almost lost its meaning because we hear it so much.
It just becomes noise after a while.
It does. But I need you, the listener, to really visualize what $143.8 billion in 3 months actually looks like.
Okay, help us scale that, because to me, it's just a number with a lot of commas.
All right, think of it this way. That is roughly $1.5 billion per day.
A day.
Every single day for 90 days straight. Christmas,
Yeah.
New Year's, doesn't matter. Or if you want to get even more granular, that's about $18,000 in revenue pouring into Cupertino every single second.
Every second.
Just tick, $18,000, tick, another $18,000, tick. It's just a fire hose of cash.
That is actually hard to comprehend. That's a mind-bending amount of money.
And here is the real kicker. It's not just the size of the number, it's the speed. That revenue number is up 16% compared to the same time last year.
And this is where the context is so important, right? Because if I tell you a tech startup grew 16%, you'd say,
That's okay, but not great.
yeah. Right. A startup is supposed to double or triple. You expect explosive growth.
Exactly. If a small software company grows 16%, their venture capital investors are probably panicking. But Apple isn't a speedboat. It's an aircraft carrier. It's the biggest aircraft carrier in the whole fleet.
Right.
And usually when companies get to this mega cap level, we're talking trillion-dollar valuations, the law of large numbers kicks in. Gravity takes hold. You expect them to grow at the speed of the economy, maybe 3%, 4%, basically tracking GDP.
Like a utility company. Safe, boring, slow. You buy it for the dividend and the safety, not because you think it's going to the moon.
Precisely. You
Yeah.
buy it and go to sleep. But 16%. That is a growth stock number. That is what we call a reacceleration. It tells us that this aircraft carrier, this behemoth, somehow just started drifting like a speedboat.
So the market is reacting not just to the money, but to the change in trajectory.
That's it. It signals that Apple isn't behaving like a mature, boring stalwart right now.
Yeah.
It's behaving like a hungry teenager again.
And the profit is just as absurd. Net quarterly profit hit $42.1 billion. That's up 19% compared to last year.
And again, look at the divergence there. That's a really important detail.
Revenue up 16, profit up 19.
Right. So what does that gap tell you?
It means they're getting more profitable.
Exactly. It tells you about operating leverage and efficiency. It means that for every extra dollar of sales they brought in, they kept more of it as profit than they did last year. They're squeezing more pennies out of every dollar. They're becoming more efficient even as they get bigger, which is, frankly, terrifying for their competitors.
So what is driving this? I mean, what is the engine here? Because for a while, the narrative, and I remember us talking about this back in 2024, was that the iPhone had peaked.
Oh yeah, that was a big story.
Everyone has a smartphone. They're all glass rectangles. Nobody needs a new one every year. But clearly, something big changed.
The iPhone 17 happened. Or maybe more accurately, the AI supercycle finally arrived.
The super cycle.
Tim Cook, the CEO, used the word unprecedented to describe demand for the iPhone 17 lineup. And, you know, corporate CEOs, especially conservative ones like Cook, he's an operations guy, not a hype man, they do not throw words like unprecedented around lightly.
No, that's not his style at all. We've been hearing about this AI supercycle for 2 years now. Since 2024, people have been saying, just wait until Apple does AI. It seems like 2026 is the year it actually landed, but explain why. Is it just a better camera again?
No, it's not the camera this time. This is a fundamental shift. The thesis was that eventually the AI features, what they're calling Apple Intelligence, would be so compelling and require so much local on-device processing power that you couldn't just keep using your iPhone 13 or 14 anymore.
Right, because the old chips literally can't run the new brain.
You've got it. If you want the on-device generative AI, the Siri that actually understands context, the real-time rewriting tools, the image generation that happens privately and securely on your phone, not in the cloud, you had to upgrade.
So the hardware became the gatekeeper again?
Yes. The hardware became the gatekeeper to the new software paradigm. And these Q1 numbers, they validate that thesis completely. This isn't just people breaking their phones and needing a replacement. This is a massive voluntary upgrade cycle. People are choosing to upgrade because they want the new features.
So the iPhone isn't becoming a commodity like a toaster or a fridge. It's cementing itself as a premium necessity. It's like you can't participate in the modern digital world fully without the latest key.
It's the gateway drug for personalized private AI.
Yeah.
And once you buy that hardware, you enter the real profit engine.
Which is services.
Services, yes. We have to talk about services. This is the hidden giant inside the giant.
The numbers here are also huge. Services revenue grew 14% to a new all-time record. And this is the App Store, iCloud, Apple Music, Apple Pay, Apple TV Plus Cup, all that stuff.
And this is where the magic of the business model really, really lies.
Yeah.
Think about the margins. When Apple sells you an iPhone 17 Pro Max, they make a healthy profit, for sure. It's a physical object. They have to pay for glass, silicon, metal, shipping, assembly labor. The gross margin on hardware is somewhere around 36 to 40%.
Which is great for hardware.
Oh, it's incredible for hardware. Most car companies would kill for a 15% margin, but it's costly to make.
Okay, so they keep about 40 cents on the dollar for a phone.
Roughly, yeah. But services is software. Once you build the App Store, once you've set up the iCloud data centers, the cost of selling one more subscription or one more app download is practically zero.
It's almost pure profit.
Close to it. Services have gross margins typically around 72%.
Wow. So nearly double the profitability of the phone.
Almost double. Which means for every dollar of services revenue, they keep 72 cents as gross profit. And as that slice of the pie gets bigger, and it is growing fast, the entire company becomes more profitable per dollar earned. It structurally lifts the profitability profile of the whole organization.
They're transforming from a hardware company into a high-margin digital landlord.
That's a perfect analogy. And I saw a number in the report that just blew my mind related to the scale of this whole thing. The installed base,
Oh, yeah.
2.5 billion active devices.
2.5 billion. That is, it's hard to even wrap your head around that. That's almost a third of the planet's population holding an Apple device.
And think of it this way. That is 2.5 billion points of sale. Every single one of those devices is a storefront. It's a credit card terminal in your pocket. Every time you open the App Store, every time you renew your iCloud storage because your photos are full, every time you tap Apple Pay. Ka-ching.
That's the famous flywheel.
That is the flywheel. You buy the hardware, which is the entry ticket, and then you spend the rest of your life paying small tolls inside their ecosystem.
Which brings us perfectly to the business model itself. We often hear the term walled garden. It sounds nice, like a secret garden with flowers and fountains, but in economic terms, it's really a fortress, isn't it?
It is a fortress with very high walls and very, very expensive exits. If you look at the revenue pie right now, iPhone is still king at about 52%. Services is now roughly 24%. Wearables, your watch, your AirPods, are about 10%. But the walled garden architecture is what binds all of them together.
It's the golden handcuffs.
Yeah.
I feel this personally. I've thought about switching to Android just to see what the foldable phones are like, but then I panic.
What stops you? What's the panic about?
The blue bubbles.
The blue bubbles.
Yeah.
iMessage. Of course.
If I leave, I'm the green bubble. I ruin the family group chat. My photos are all in iCloud, terabytes of them. My Apple Watch won't talk to a Google Pixel. It feels like too much work, like a massive, painful project.
And that is exactly what they want, that feeling of inertia.
Oh.
Let's say you decide to leave Apple. You lose your iMessage history in the blue bubbles. You lose the seamless integration where you copy something on your phone and paste it on your Mac.
Handoff. Yeah.
You lose all the paid apps you've bought over the last 10 years. You have to buy them all again on the Google Play Store.
It becomes a logistical nightmare to leave. It's like moving house, but the moving truck costs $5,000 and you lose half your furniture on the way.
A perfect analogy. And that's why their customer retention rates consistently hover over 90%. It's not just loyalty, it's friction. High switching costs are a massive, massive component of their economic moat.
Let's unpack that moat concept a bit more. We hear Buffett talk about moats all the time. Apple seems to have a few layers of defense here.
They have what you'd call a very wide economic moat, protected by, I'd say, three main fortifications. First, as we just discussed, the high switching costs. That keeps people inside the walls.
Okay, so that's defense.
Right. Second is intangible assets, specifically the brand. Apple consistently ranks as the world's most valuable brand, and this gives them something incredible: pricing power.
Explain pricing power in this context. What does that mean practically?
It means they can raise the price of the iPhone Pro by $100, and people still buy it. And in fact, sometimes demand goes up because it's seen as a more exclusive status symbol.
So it defies the normal laws of economics.
It defies standard price elasticity. Usually in Econ 101, when prices go up, demand goes down. With Apple, prices go up and status goes up. It behaves almost like what's called a Veblen good, like a Birkin bag or a Ferrari. The high price is part of the appeal.
And the third fortification?
Network effects. This is the magic of the App Store. Because iOS users are the ones who spend the most money statistically, iPhone users spend way more on apps than Android users. The best developers build their best apps for iOS first.
I've noticed that. The cool new app always comes out on iPhone first.
Always. And because the best apps are on iOS, more of the high-value users join iOS. It's a self-reinforcing loop. More users means better developers, which means better apps, which attracts more users. It's like a toll bridge for the digital economy. If you want to reach the most valuable customers in the world, you have to cross Apple's bridge and you have to pay the 30% toll.
It sounds perfect. It sounds like the perfect business.
It is a wonderful business. There's absolutely no debating that. It is arguably the best business ever built by human beings.
But I sense the but coming again. I can hear it in your voice.
But investing isn't just about buying good companies. If it were that easy, we'd all just buy the top 10 companies on the Fortune 500 list and go to the beach.
Sure.
Investing is about buying good companies at the right price. And this is where we run into the massive conflict in this deep dive. The bull versus the bear debate.
Okay, let's play this out. I'll take the bull case for a minute. The narrative seems incredibly strong. The AI supercycle is real. We just saw the numbers to prove it. The ecosystem is inescapable. 2.5 billion devices. And the quality of the business is just undeniable. I'm looking at the ROIC, the return on invested capital. It's over 50%, even 60% in some estimates.
That is elite. Just to clarify that for the listener, that means for every single dollar Apple invests into its own business, into new factories, data centers, R&D, they get 50 to 60 cents back in profit.
Yeah.
Every single year.
That's insane.
It is. Most companies kill to get 15%. So yes, the bull case on the quality of the business is ironclad. You are owning a literal money-printing machine.
So if the quality is elite and the growth is reaccelerating from this massive base, why are we even having a debate? Why isn't this a buy everything you can, mortgage the house kind of situation?
Because of the math. This is where we have to take off the consumer hat, the person who loves the iPhone, and put on the cold, hard investor hat. We have to look at the valuation.
The price tag, what you pay for that quality.
The price tag relative to what you get. Right now, as we speak, Apple is trading at a price-to-earnings ratio, or PE, of somewhere between 33 and 35 times its earnings.
Okay, is that high? I mean, Amazon used to trade at 100, Nvidia trades at 50 or 60. 35 doesn't sound crazy in the tech world.
For a high-flying tech growth stock, maybe not.
Right.
But for Apple, historically, yes, it is very high. Apple's 10-year average PE is closer to 20 or 25 times.
Yeah.
So right off the bat, you are paying a huge premium compared to its own history. You're essentially paying for 35 years of its current earnings to own one share of the stock.
Okay, so it's expensive relative to itself.
But the real problem isn't just its own history. It's the yield gap.
All right, let's unpack this slowly. Yield gap. I hear this term thrown around by bond traders and financial news talking heads. Break it down for me like I'm 5. Or maybe like I'm a smart 12-year-old.
So, deal. Let's imagine you have $100 in your pocket right now. You have 2 choices for what to do with it. Choice A. You lend that $100 to the U.S. government for 10 years by buying a treasury bond.
Okay. Uncle Sam, pretty reliable borrower. They have a printing press, so they're good for it.
The most reliable borrower in the world. And right now, the government says, thank you for the $100. In return, we will pay you 4% interest every year, guaranteed. So you get $4 a year, 0 stress, 0 risk.
Got it. That's my baseline. The risk-free rate, 4% in my pocket, guaranteed.
Now, choice B. You take that same $100 and you buy a share of Apple.
Which is way more exciting than a government bond. I can talk about it at parties.
Much more exciting. But let's just look at the math for a second. Apple is trading at a PE of about 35, right?
Right.
If you flip that number over, so you divide 1 by 35, you get what's called the earnings yield. This is effectively the profit that your $100 share generates for the company in a year.
And what's that number?
It's roughly 2.9%.
Wait, pause, hold on.
I'm pausing.
You are telling me that if I take the safe option with the government, I get paid 4%. But if I take the risky option, owning a volatile stock that could crash tomorrow, I'm effectively only earning 2.9%.
That is exactly what the math is telling you today.
That sounds completely backwards. In finance, in life, shouldn't I get paid more for taking on more risk? That's the whole concept of a risk premium, right? I should get the 4% plus a little extra for the stress and uncertainty.
Bingo. That is the fundamental rule of investing. You demand a premium for taking on risk. But right now, with Apple stock, the premium is negative. You are effectively paying for the privilege of taking on risk.
Why on earth would anyone do that? That sounds like charity, not investing.
Because of the narrative. Because of the story we just discussed. The market is betting that the 2.9% won't stay 2.9%. They believe the AI supercycle is going to blow the earnings up so fast that in 3 years your yield will be 10%.
So they're paying today for growth that hasn't happened yet.
They're paying today for a decade of spectacular growth. The market is pricing Apple as if it's going to grow its earnings at 15 to 18% annually for the next 10 years.
It's priced for perfection.
Exactly. At $258 a share, the price assumes that absolutely nothing goes wrong. It assumes the AI supercycle accelerates, services keep booming, China behaves, and no regulators get in the way. But the reality check is that even in this record-breaking quarter, revenue grew 16%. That's amazing, but sustaining 15 to 18% for a decade. For a company with a $400 billion revenue base, that is statistically, historically, incredibly difficult.
And if they slip?
If they grow at only 10% instead of 15%, which is still great growth for a company this size, the stock could plummet because that premium you paid evaporates instantly.
It feels like standing on a very high ledge. The view is fantastic, but a gust of wind could be a real problem. If you're walking on the sidewalk and you trip, you scrape your knee. If you're walking a tightrope 35 floors up and you trip,
the outcome is very, very different. That is the risk today. And that leads us to another paradox. The capital allocation paradox.
Ah, yes. We have to talk about the buybacks because I want to push back on the negativity for a second. We're ignoring the elephant in the room.
Which is
Apple is practically a machine that eats its own shares. They have a $110 billion buyback authorization. In Q1 2026 alone, they returned $32 billion to shareholders through buybacks and dividends.
It is a staggering amount of capital being returned.
And as a shareholder, I love this, right? They're constantly buying their own stock in the open market, which reduces the total number of shares. That means my slice of the pizza gets bigger without me spending a dime. How can you possibly spin that as a negative?
I'm not spinning it. I'm just doing the math. You're right. Your slice of the pizza does get bigger. But the crucial question is, how much did the company pay for that extra slice for you?
They paid the market price.
Exactly. They paid $258 a share. Let me give you that pizza shop analogy. Imagine you and I own a pizza shop together, 50-50. The shop is worth $1 million, objectively, based on its cash flow.
Okay, we're pizza moguls. I like it.
Now, I want to retire and leave the business. You decide to use the company's cash from the register to buy out my half of the business. But instead of paying me my fair share, $500,000, you get caught up in the hype about our new pepperoni, and you pay me double what my share is worth. You pay me $1 million for my half.
Well, that's great for you. You walk away rich.
I'm thrilled. But what about you? You still own the shop now, 100% of it, but you just drained the cash register to massively overpay for my exit. The business itself is now poorer because you spent $1 to buy 50 cents worth of value.
I see exactly where you're going. You're saying Apple is the one draining the cash register to buy shares at an inflated price.
At $258 a share,
Right.
Yes. This is the capital allocation paradox. When a stock is cheap, buybacks are magic. They are incredibly accretive and create wealth for the remaining shareholders. But when a stock is expensive, buybacks are a form of value destruction. They are incinerating cash that could have been used for a special dividend or a big acquisition or more R&D just to prop up a stock price that is already historically high.
So you're saying Tim Cook is buying high.
I'm saying the math suggests he is buying high. It creates a floor for the stock price in the short term, sure, because there's this massive constant buyer in the market every single day. But in the long term, it is not compounding wealth as efficiently as it could be. It's a defensive move, not an offensive one.
And this might explain the next big signal we have to discuss, the Buffett signal.
This is the real elephant in the room.
Warren Buffett, through Berkshire Hathaway, has been the biggest cheerleader for Apple for years. It was his biggest holding by a country mile. He called it the best business he knows in the world.
He did. He loved it.
But throughout 2024 and 2025, he has been selling, and not just nibbling at the edges, aggressively selling.
He has sold hundreds of millions of shares, trillions of dollars worth. He hasn't exited the position completely, but he has trimmed it significantly. He basically cut it in half and then cut it again. And you have to ask yourself, why?
Is he losing faith in the business? Does he think the iPhone is done or the AI thing is a bust?
I don't think so for a second. I think Buffett still loves the business. He loves the moat, the ecosystem, the brand. But Buffett is disciplined on price. He's a value guy at his core. Remember, his cost basis, the average price he bought in at, was around $35 to $40 a share.
And he's been selling at $180, $200, $230.
He is locking in a gargantuan win, a life-changing amount of money even for him. But more importantly, it signals to us that for him, the margin of safety is gone.
Margin of safety, the cornerstone of value investing.
Right. Buffett has a famous quote, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." For a long time, Apple was that, a wonderful company at a fair price. Now, it's a wonderful company at a wonderful, meaning very, very expensive price. The odds are no longer heavily in his favor.
Let's run Apple through the deep value investing standards checklist. You know, the stuff Ben Graham, Buffett's mentor, would look at. Let's be ruthless here.
Okay, let's do it. First, valuation. Is the PE under 15?
No, it's 33. Big fail.
Is the price-to-book ratio under 1.5?
It's 58. A massive, massive fail. That means the stock price is 58 times the value of their actual tangible assets, like buildings and inventory.
A chance generation.
Pass exemplary. A++. They print money.
Balance sheet strength.
Okay, they have net cash, or they're very close to it.
Okay.
They are financially bulletproof. They could survive a decade-long depression.
So the verdict from a strict old-school value perspective.
It's a high-quality growth compounder, one of the best ever, but it is absolutely 100% not a value stock right now.
Correct. It fails the value test.
Yeah.
And when you own a growth stock that is priced for perfection, you have to worry about risks. You have to constantly ask, what could derail this 15% growth assumption the market is making?
So let's look at the headwinds, the things that could pop this beautifully inflated balloon. The first one is always geopolitics, and specifically China.
We can't ignore this. It's the sword of Damocles that just hangs over this stock perpetually. Greater China accounts for about 19% of Apple's total revenue. That is a huge customer base.
19% is a big chunk.
It is. But even more critical than the customer is the supply chain. More than 90% of their manufacturing and assembly still ties back to that region.
We've seen them trying to move more production to India and Vietnam, though. I see made in India on some iPhones now.
Yes, but it's slow going. It takes decades to build the kind of ecosystem and infrastructure they built in China. It is a massive ship to turn. The big risk here is what people call decoupling.
That's it.
If we get into a serious trade war, or if tariffs ramp up again, or God forbid there's a geopolitical crisis in the Taiwan Strait, those supply lines could be severely disrupted or even severed.
And it's not just about making the phones, it's also about selling them there.
Exactly. A rise in Chinese nationalism could lead consumers there to switch to domestic brands like Huawei. We've already seen hints of that. The Chinese government banning iPhones for state workers, for example. If Apple loses China, both as its factory and as a major customer, the growth story breaks instantly.
Okay, that's a big one. Then there is the regulatory siege. We mentioned the golden handcuffs earlier. Well, the governments of the world are coming with bolt cutters to pick those locks.
They are. The EU is leading the charge with its Digital Markets Act, the DMA, and the U.S. Department of Justice is right behind them. They are directly attacking the walled garden. They want to force Apple to allow sideloading, which is just a fancy word for letting you install apps without going through Apple's App Store.
And if that happens, Apple loses that 30% cut they take on every transaction, the Apple tax.
Exactly. That is a direct threat to the high-margin services revenue we were just praising. If Netflix or Spotify or Epic Games can tell their customers to download their app directly from their website and bypass Apple's payment system, that 72% gross margin in services comes under immense pressure. The toll booth operator suddenly has a giant hole in the fence where people can just walk through for free.
It's a direct threat to the most profitable part of the business.
The single biggest threat, I'd argue. And the third risk is something more existential. It's the innovation dilemma, or what some people call the law of large numbers. It's just simple math. To grow a company that already has a $400 billion revenue base by just 10%, you need to find $40 billion in new revenue.
$40 billion, that is the entire size of a Fortune 100 company.
Precisely. You have to basically invent a company the size of Coca-Cola out of thin air every single year just to keep growing at a decent clip.
Is the Vision Pro going to be the headset? It seems like their next big bet.
It's incredibly impressive technology, but is it a mass market product like the iPhone was? Not yet. It's still very niche, very expensive. Are autonomous systems, the Apple Car, going to be the answer? Maybe. But the bar is set so incredibly high that even a great success might not move the needle enough to justify the current valuation. When you're this big, gravity just pulls so much harder.
Okay, we've looked at the record-breaking numbers. We've admired the incredible moat and the sticky ecosystem. We have stared into the abyss of the valuation and the yield gap. We have listed the very real risks. It is time for the verdict.
This is the hard part. This is where feelings can get hurt.
The research team has crunched the data, run the models, and debated this for hours. The question is, do we buy, sell, or hold Apple at today's price of roughly $258 per share?
The deep value intelligent conclusion is sell, avoid.
Sell. Wow. That is a bold call for the biggest, most beloved company in the world. People love this stock. It feels safe.
It's a disciplined call. And look, let's be very clear about what we're not saying. We aren't saying Apple is going to zero. We aren't saying the business is crumbling. We are not saying Tim Cook is doing a bad job.
You're just saying the stock is too expensive.
We are saying that as an investment right now at this specific price point, it offers a poor risk-to-reward ratio. You are taking on a lot of risk for potentially very little reward.
Walk us through the rationale one more time. Summarize the case for the prosecution.
Okay, 1, zero margin of safety. The PEG ratio, which is price to earnings growth, is over 3. You typically want that to be near 1. You're paying a triple premium for future growth.
So you're paying too much for the story.
Way too much. 2, the yield gap. It's just bad math. You are taking on equity risk for a 2.9% earnings yield when you could sit in risk-free treasuries for 4%. That is just bad asset allocation. It's inefficient.
You're not being compensated for the risk.
Not at all. And 3, the risks we just talked about, China, regulation, are non-zero. But the price assumes they are zero. It assumes a perfectly smooth ride ahead. So we believe it's better to buy a wonderful company at a fair price. And right now, the price is not fair. It's full, bordering on euphoric.
So if we sell now or avoid buying, we are sitting on cash. When do we get back in? Because I know people want to own this company. I want to own this company. It feels good to own it.
Of course. It's a company you absolutely want to own eventually. It belongs in a long-term portfolio. But patience is the most expensive and rare currency on Wall Street. The research team has set a specific re-entry target. We are watching for a pullback to the $175 to $185 range.
That's a significant drop from here. That's like a 30% correction.
It is. It sounds drastic, and maybe it won't happen. But that price range would bring the PE ratio back to roughly 25 times, which is its historical average. That is what Buffett would call the fat pitch. Investing is a game of patience. You don't have to swing at every pitch. You can wait for the one that is right in your sweet spot.
So the strategy is take the profit now, if you have it selling into this strength, put that cash into short-term treasuries earning a safe 4%, and just wait.
Exactly. Let the market cool down. Let gravity do its work. Valuation acts as gravity on a stock price. No matter how good the business is, if you overpay, your returns will suffer. We are choosing to wait for gravity to bring the price back to reality.
It's a tough pill to swallow when you see all the hype and the green arrows, but discipline is what separates the pros from the gamblers. It's about ignoring the FOMO, the fear of missing out.
Precisely. FOMO is the enemy of ROI.
Before we wrap up, let's do a quick summary of what we've covered today, just to lock it in.
Sounds good. 1. Apple posted incredible Q1 2026 numbers. Revenue up 16%, profit up 19%. The business is firing on all cylinders.
2. The iPhone 17 and Apple Intelligence have triggered a real bona fide upgrade supercycle. The hardware is the gatekeeper to AI again.
3. The moat is wider than ever with 2.5 billion devices. The ecosystem is incredibly sticky. It's a fortress.
BUT4. The valuation is stretched to what looks like a breaking point. A 33 times PE implies a future of pure perfection.
5. The yield gap is negative. From a pure risk-reward standpoint, you are better off in bonds than holding Apple at this price for the short term.
6. The smart money, like Warren Buffett, is taking chips off the table. They're selling into the strength, not buying into the hype.
And therefore, 7. Our verdict is sell or avoid and wait for a better entry point around that $175 to $185 mark.
And as we leave you today, here's a provocative thought to chew on. We often think of Apple as the safe haven of the stock market. When things get scary in the world, people pile into Apple stock because it feels like the safest house on the block.
Right, it's the digital version of gold.
But what if the safe haven itself is priced for perfection? What happens if it misses a step? If it stumbles on the next AI feature, or it gets hit hard by an EU regulation? What happens to the rest of the market? If the anchor starts to drift, does the whole boat drift with it?
That is the scary question, isn't it? If the general of the army falls, the troops usually scatter. If Apple catches a cold, the S&P 500 might just get pneumonia.
A sobering thought to end on. Remember, to keep track of these valuations yourself, to track total market temperature, welcome to search and download iOS app Buffett Indicator from Apple App Store. It's a great tool to see if we are in buy territory or sell territory based on historical data.
And one last time on the disclaimer. Full deep value research reports can be found in the description links. All analysis is based on publicly available sources and may be subject to revisions or differing interpretations. The content is for educational purposes only and does not constitute investment advice. Conduct your own due diligence before making investment decisions. And if you want to listen to our full deep dive about this topic or access more advanced contents, welcome to join Deep Value Club members.